If you've ever had a client who worked for two different companies in the same year, you've probably seen this exact problem. They've paid way too much in Social Security tax. Now, it seems like a simple fix, but getting it right, oh, it is all about the details. So let's dive right in and unpack exactly how to reclaim that excess withholding step by step. So here's our roadmap. We're going to break this down into 6 parts. We'll start with the Social Security limit itself, then we'll look at the specific law that actually lets us claim a refund. After that, we'll tackle the single most important distinction you need to make in these cases. Then we'll get into the mechanics of the Schedule 3 credit, how to calculate it, and to wrap it all up, we'll take a little peek at how the IRS processes these claims behind the scenes. All right, first things first. The absolute foundation of this entire topic is the Social Security wage-based limit. You see, every single year, there's a hard cap on how much of a person's income is even subject to Social Security tax. Understanding this limit is the key to spotting when an overpayment has happened in the first place. For 2025, this right here is the magic number, $10,918.20. Under federal law, that is the absolute drop-dead maximum Social Security tax any one person should pay for the entire year, not 1 penny more. Okay, so that leads to a pretty obvious question, right? If there's a legal max, how is it even possible to overpay? Well, the answer really lies in the decentralized nature of U.S. payroll. Think about it. Each employer is its own island. They withhold tax based only on what they pay an employee, and they have no clue what other jobs that person might have. The official IRS term for this whole concept is the contribution and benefit base. For 2025, that base is set at $176,100. Any dollar earned above that amount, it's just not subject to the 6.2% Social Security tax. This income ceiling is the entire reason that tax cap we just saw even exists. And, this base isn't static. It's indexed for inflation, so it adjusts every single year, as you can see right here. I mean, that's a pretty significant jump of almost $8,000 from 2024 to 2025. This constant movement is exactly why you have to double-check the correct limit for the specific tax year you're working on. So the system itself can and does create an overpayment. How do we fix it? Well, we have to look to the law. There's a specific section of the Internal Revenue Code that gives us the exact authority and the remedy for this exact situation. And this is it right here. This is the core legal principle. Internal Revenue Code Section 6413C1, it explicitly creates what it calls a special refund. But notice the most important part, the gatekeeper phrase, by reason of an employee receiving wages from more than one employer. That language is not an accident. It is the absolute non-negotiable prerequisite for using the remedy we're talking about today. And that brings us to what is, without a doubt, the most important fork in the road for any tax professional handling this issue. You have to correctly diagnose the cause of the overpayment. Was it because of multiple employers, or was it just a mistake by one? Because the answer to that question dictates the entire recovery process. Let's break this down. Over on the left, you've got the multi-employer scenario. This is our focus. Here, you have 2 or more employers who correctly withheld tax, but their combined wages just push the employee over the annual limit. Each W-2 is technically accurate on its own. The path here is claiming a credit on Schedule 3. Now, on the right, you have a single employer error. This is a straight-up payroll mistake. One company withheld more than the maximum all by itself. That means the W-2 is incorrect. The remedy here is not Schedule 3. It's going back to the employer for an adjustment. And just to be crystal clear on that single employer error, the IRS wants the employer to fix their own mistake. They're supposed to issue a refund to the employee and then file a Form 941-X to true up their own records and get their matching FICA contribution back. It's only if the employer refuses or just can't make the adjustment that the employee can then file Form 843. And this path is explicitly forbidden if the overpayment was caused by multiple employers. Okay, so we've established our client has a multi-employer overpayment. Now, how does this special refund actually get onto their tax return? The law performs this really neat little trick, basically transforming a payroll tax issue into a refundable income tax credit. Here's the legal alchemy. Internal Revenue Code Section 31B takes that special refund we saw in 6413C and says, hey, for the purpose of the income tax return, we are going to treat this money as if it were regular old income tax withholding, just like the amount in Box 2 of a W-2. This is the mechanism that makes it a refundable credit. And the Treasury regulations just hammer this point home. Regulation 131-2A2 couldn't be any clearer. It says if you file an income tax return, you can only get this money back by claiming it as a credit. It explicitly slams the door on using Form 843 for the multi-employer scenario. So the takeaway is simple. Multiple employers means a credit on the 1040. A single employer error means going back to the employer first. All right, that's enough theory. Let's get practical. How do we actually calculate the credit that goes on the return? The good news is, once you've done all the diagnostic work, the math itself is actually very, very simple. Okay, here's a classic 2025 scenario. A client worked at Tech Corp, earning $120,000, and also did some consulting work as an employee for another LLC where they earned $80,000. Now, each employer correctly withheld the 6.2%. The total Social Security tax taken out of their paychecks was $12,400. The calculation is a super simple three-step process. First, you add up the Social Security tax withheld from Box 4 of all the W-2s. In our example, that's $12,400. Second, you subtract the legal maximum for 2025, which is that $10,918.20 number. And third, the result is your credit, $1,481.80. Simple as that. And where does this number go? Well, for current tax years, it has its own dedicated home. You're going to report it on Schedule 3 of the Form 1040, specifically in Part 2, which is for other payments and refundable credits, on line 11. Now, for a section you definitely won't find in the public instructions. Let's pull back the curtain and see how the IRS's own internal systems are designed to track and validate this specific credit. Understanding this can actually help you diagnose e-filing rejections if they ever pop up. So when your tax software transmits a return, that number from Schedule 3, line 11, isn't just floating in cyberspace. It's mapped to a very specific data field. The Internal Revenue Manual, or IRM, shows us this is field 05SS. Knowing this designation can be really useful when you're trying to decipher transcripts or communicate with the IRS about a specific credit. And this is where the automation really kicks in. When the modernized e-file system, or MEF, gets a return with this credit, it often attaches a special processing code, V. This V is an internal flag that tells the system to run an automated check, comparing the credit you claimed against all the W-2 data the IRS has for that Social Security number. This is how the rules are validated electronically, behind the scenes. So let's boil this all down into a quick practitioner checklist. First, always confirm the overpayment is from multiple employers. Second, check that no single W-2 is over the limit, because if it is, that's a whole different problem. Third, do the simple math. Fourth, report it on Schedule 3, line 11. And finally, just be aware that automated systems are double-checking your work. And this really brings us to a final thought. In an increasingly automated tax system, our value as professionals isn't just about filling out the forms. It's about correctly diagnosing the underlying facts. The system can check the math, but it's relying on you, the professional, to correctly identify whether it's a multi-employer credit or single-employer error. And that distinction, that's where expertise truly matters.